Hey everyone, welcome back to my YouTube channel. Today was going to be a fun one. We're going to look at basically the core of the system that I use, how to get into the market after big kind of declines and market corrections. For those of you who didn't watch the original or the first episode, this YouTube series is kind of just a place for me to talk markets, kind of talk through my strategy, concepts that I use, go through trades, past trades, look at model book stocks, that type of thing. If you don't really know, what the process I'm kind of going through, hopefully you can kind of learn something. And of course, this is for me to kind of look back on in the future and, learn things from obviously doing these as well, hopefully. Like I said, there was a short introduction one as number one on the playlist. Would probably recommend going over that and kind of going through the process of what moving averages that I use and how the chart kind of looks. Went over the open, high, low, close candlesticks that I use. So yeah, that's probably a good starting point. So today, the focus is on follow-through days, what they are, why I use them, and how they can get us back into the market when often the news is really negative after a big decline in the market. So we'll be going over obviously a few examples of history, and like I said, in the original, the first video, I should say, that I did, kind of explain that everything that I do is the foundation kind of comes from this book, How to Make Money in Stocks, which is, I think, just, quite cheap online, 10 or 12 pounds, nothing too crazy. And that's what got me into investing and trading in the first place. So, a follow through day is kind of the easiest way to describe it for people that don't know too much about the markets is a big up day that comes 4 days or later after a big market decline. So I'm going to show a few examples of that. The idea is often when there's a big market correction, it can be really tricky of knowing when to get back in, when to start putting money on the table, chips at risk, and how to, I guess, accumulate positions when the markets come a significant way down. It often feels really scary and tough to buy in these positions. But this concept kind of gives us a backdrop to say, we need to be more aggressive. We need to be putting on risk based on having a follow through day or not having a follow through day. So I'm going to share my screen and I'm going to go over a few different examples here. Okay. So this is the November 2018 correction, bear market. So you can see here from the highs, the market came down 23%. So we're looking at the Nasdaq Composite, which is just an index that you can use to, I guess, call this the general market. This is kind of the main index that I use. So the average stock, or I guess the index, came down 23%. Now the names that I trade, more quicker moving names, these can go down 1.5x to 3x, the move of the market up or down. So in this case, stocks might have come down 40, 50%, which we wouldn't want to be in for. Obviously, we'll go over at some point rules of getting out and being more defensive, obviously to prevent us going down like this. The way I trade, I want to take advantage of, the good areas, and then, take positions off when when it looks like we're heading into trouble to avoid these downturns. And the idea is compounding, these nice trends over time, to make significant returns, hopefully, and beat the market as an index on an index level. So, the idea is that we would get this trend here, and then sidestep this, and then get back in around here, which brings me on to the follow through day and why we use it. So, like I said, a follow through day is a big up day. After we've had a significant downturn in the market, it was, I guess, created for big market declines. But now recently it's more used kind of after like an intermediate correction, which is like 8 to 12%. They can be used there too. So the concept is we have a big decline, and obviously in hindsight we can see that this goes up. But when would we kind of need to get back in? So what we say is, when the market's coming down, we're looking for a day that closes higher than the day before. That's how we start counting on in this process. So we've got a big down day here. This on 29th of October, this was down 1.63%. Okay. And then the next day, it's up 1.58%. So it's not made a new low. The low here is 6922.83. So what we can do is we'll just, mark this low here. This is a significant area for now. So this would be day one. And again, the next day it follows up another 2%. So that would be day two. Then the third day it's up 1.75%. So day three. So now day four onwards, we can look for another big up day, which is a signal to get back in the market. So day five is not up, it's down minus 1.04%. The next day, day six, is down again. Day seven is up 0.64. Okay, but that's not really enough. So what we look for is a gain of usually 1.25% or more on an index level. It can in low volatility environments, it can be 1%, but typically it's 1.25. And then here, so now we're on 1, 2, 3, 4, 5, 6. Day seven, the market is up 2.64%. And we're now back above the green line, which is the 21 day. So that's here. Get an arrow. So this bar here, okay, is a follow through day. And what would we do here? So like I said in my first video, the green line, which is a 21-day EMA, so exponential moving average, is basically the foundation of everything that I do. If we're above the green line, we're in a positive environment. If we're below it, we're in a negative environment, downtrend, and we want to stay very cautious. But of course, you can get follow-through day signals below the 21-day line. So it's kind of a mix of both that we have to, look at. So here on day seven, what was it? 1, 2, 3, 4, 5, 6, 7. We've got day seven follow-through day. So for this, the main line in the sand is the low of the follow-through day. So if we were to go below it intraday, that's okay. But a close below the follow-through day negates it because the odds of it working after that are very slim. So what we're going to do is we're going to put a line here. What color? Orange. Oh, not orange. We'll go a red line. So this, if closed below the red line here, would obviously negate the follow-through day, and the ultimate low is this 6922.83. So with the ultimate low, if this follow-through day fails, we can look for another follow-through day immediately without undercutting this low. But if we undercut it, we have to start counting again. So you see the next day, we're down 0.53%, but we're above the 21 day. So if stocks are setting up in good patterns and look viable, we can start increasing exposure here. Now, the next day obviously is a bad day, down 1.65%, and it closes below the low of the day seven follow-through day, which is bad. So what we would do is we'd back away from anything we buy in here. Okay, and then we're back to cash in like a cash position. No, we wouldn't really want to own anything when we're below the 21-day line and below the low of the follow-through day. But ultimately, it's still below this ultimate low of 6922.83. And so we can keep looking for another follow-through day, another sign that we can kind of put on, put the foot down on the gas. But ultimately, we were looking for a trend higher, and you were not going to get that if obviously by definition a lower low and a lower high is the definition of a downtrend. So I'm going to delete this line now. So we had the follow through day here. We'll leave that one on just as a marker, but now again we're going down here. So this is a bad break below the 10-day, which is the pink line. Okay, we keep going down, and then here we have this day up 1.72%. So again, this is technically a follow through day because we're above the ultimate low. But this is where it gets interesting because, and as we can see, obviously what plays out. But again, it's not just kind of the numbers and the science behind it. There's also a look and like feel to it. So as you can see here, this follow through day looks great because it's going up above the green line, which is 21 day. It's gapping up. So it's making a statement that it wants to go higher, and ultimately it doesn't work. But this one here feels different because it's not closed higher than the previous day's high, and it's kind of stuck between, well, it's below the 10-day, below the 21-day, it's below the 200-day, and below the 50-day. So it's below all the key levels that we look for. And yes, it's up enough to classify as a follow through day, but it just doesn't feel as strong as this one did, if that makes sense. But we have one anyway. So you could maybe buy some, Q's positions, some SPY, just some market ETF to kind of get some exposure, but you wouldn't be pressing on the gas as much as you probably would here because of the position that it's in. It's a weaker position than this one. So again, the next day it's a blue bar, but it says down 0.15%. And the reason this candle is blue here is because it closed above the open, but it was still down on the day. So then again, the line that we would be looking for this follow through day is a close below the low, and we get it 2 days later. So again, this one fails. And then the next day we gap down and we close minus 1.7%, and it undercuts the low of the original follow through day. So now we have to start counting again, which makes the process obviously more into the future because whilst we were counting here, so this would have been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This would have been in day 13 follow through day. This was day 7. Now we have to start counting from day 1 again because we've undercut this level. Let me just check the closing range on that. 47. Okay. So this bar here is interesting because it gaps down and it closes off the lows, and it closes above where it opened. So that's the reason for the body of the candle to be blue like that. I don't like the top wick on it. However, if this closed with a closing range greater than 50%, which means the spread between the high and the low. So let's say if the high was 102 or 102 and the low was 100, if it closed at 101 or greater, we can actually count that as day 1 because although you've come down, it says it's come down, found support and closed up, or in the upper 50% of the range. That's classed as a pink day rally day, which would be day 1. Again, there's a lot of words and terms flying around, but basically what it means is although it's a down day, it's actually showing support, so we count it as day 1. Whereas with this one, we can't because the closing range here is 47. Okay, so we can't count that on that day. So again, I'm going to delete this line, or actually just move it to here. This is the ultimate low because the next day we then gap up, close up 0.92%. So that would be day 1. This is day 2. This is day 3. Day 4 is flat. And then day 5 here, we have a follow through day 5, which is good. You typically want to try and get them in days 4 through 10, but it doesn't always work like that. And again, you can see this follow through day here is much stronger, or looks much stronger than this one, because it's back above the green line, the 21 day, it's above the 10 day, and it's showing power and pushing out, whereas this one just didn't. And ultimately it rolled over. So again, we're now looking at the low of this day as our line in this first line in the sand. A close below this line would pretty much mean that it's likely to fail. Okay, and then a break below the ultimate low would be, we'd have to restart the count. So again, we hold above the green line and we push out here. So you could be adding exposure here. We gap up, but then get rejection at the 200 day and a decline in 50 day, which is really important. It's quite difficult to break through a declining 50 day when it's up near the 200 day like that. And then it breaks lower again. That's a bad break, 3.8% and a close below the 21 day. So you'd be backing away again from anything that you bought in here and watching this ultimate low. So you see we gap down the next day but close up. So that would have been pretty painful if you had anything in here. And then the next day, an expectation breaker, it breaks below the line here. So we're going to have to delete this line again. So that's three failed attempts really. It gets it. Is it perfect? No, but find another, try and find another system that can get you in and out and, be nimble. It's really difficult. And, in here, that's a terrible bar. You would never buy that candle. And you could say, well, if you bought on that day, it works out, but only for a little bit. And then it breaks lower again. And then you could say, well, on this bad day, you just buy more, right? Because, it's cheaper. Well, no, because yes, it works for a little bit, but it gets a lot worse. So we can see down here, this was, I believe, Christmas Eve 2018. I think the Jerome Powell came out in this time and did a rate cut, I believe, which obviously turned the markets higher. But we can see here, we can play this out bar by bar now. So we've got a really bad candle. So this is, it kind of looks like a crash, honestly, because just relentless selling down every day. So this is 2.17%. Then we get the next day 1.63, almost 3%. And then the close at the lows, literally almost the low of the day it closes at on the Christmas Eve, 2018, down 2.21%. The next day, the next trading day, Boxing Day, the 26th, we have this huge up day. So up 5.84%. So that is day one. Okay, so that's the ultimate low that we're looking at. Okay, day 1, 2, 3, 4. So now we can start looking for a follow through day. So this is up 0.77%, so not enough to qualify. Next day up 0.46. And then a down day the next day minus 3%. So that's really tricky. That's a terrible looking candle. Obviously, again, it's similar to this one, close at the low of the day almost. And you see you gap down here and you push up. So that was a positive. And then we gap down and stay down the next day. So that's kind of like you wouldn't expect that after this candle. But the next day, this is huge piece of information. You gap up. So we closed at 6. What's the close here? 6,463.50. And then the next day we open up, 6,567. So what's that in percentage terms? We gap up 1.7%. So a big gap up on an index level. And then we push higher all day, up 4.26%. So with this candle, you would expect really that it goes lower here. It's closed at the low of the day. It's come down all day and it's pointing straight down. You would expect the next day further selling and probably test this 6,190 level below the rally attempt. But no, it bounces up pre-market and then just goes higher all day. So that would be 1, 2, 3, 4, 5, 6, day 7 follow through day. So again, we can mark this one. And then what happens the next day? Okay, the next day up again, 1.26, and then above the green line again, above the 21 day, even more positives. So you could probably call that a subsequent follow through day. So one important thing with this system is once you have a follow through day, you want to see more come in, which gives you greater evidence that the trend is going to work in your favor. So as I said, we didn't get any here. Obviously, it was next day was flat and down. Um, again, didn't get any here. Straight down after that. We didn't get any here. And I wouldn't count that because that's up 1.51%. So again, greater than the 1.25. However, it doesn't look powerful. It doesn't look supportive. It looks like you gap up and then you just fade kind of all day. And then obviously it breaks below here. So what's different about this now is you can see a tangent here. Sorry, but you're always trying to stack kind of the information and the odds in your favor. So you've got how I see it. This one is you've got one break down here, and then it rallies up, and then you've got another break here to make a new low, and then it rallies up again. So you're thinking, oh, nice, we've tried once and it failed, comes down. We're trying it again. Oh, this time it'll work. And no, frustratingly, it doesn't. Breaks down again. So you got these three waves down. And by this point, everyone's kind of washed out, frustrated, and annoyed. People have lost money in this period, which obviously isn't nice at all, but it turns people away from the market, which sometimes you need to kind of wash out all the enthusiasm, as horrible as it sounds, kind of make the sentiment really poor so that you can go on a big sustained move up after that. So we get a follow through day. I think we said day 7. 1, 2, 3, 4, 5, 6, 7. Yeah, day 7. We get subsequent follow up the next day. So another follow through day. And then what happens? So we've got again above the 21 day for 2 days now, 3 days, 4 days here. So again, another part of my rules and process is that when you get the low above the follow through day, low above the follow through day. If you get the low above the green line, the 21 day, that's again more information to say this trend has changed in character and we should be pressing on the gas. So you can see here on the 7th of January, we get the low is just, I mean, it might as well, it's five points off, but in spirit is above the green line. So that's the 1, 2. So that's 3 days here where you could say the low is above or almost above the 21 day green line. And that is a rule in itself to be increasing exposure. So you've got the follow through day where you want to buy something. You have to just test the market because you never know if it will work or not. The next day you have the subsequent follow through day and you get above the 21 day line. So that's again more information to say this trend is different this time, increase exposure. Then you get 3 days up or 3 days with the close, 3 days with the low above the 21 day and you close up on the day. That's important. You can add exposure here. So we should really be, quite heavily invested at this point. And then we can just play this out. So again, it's coming down, doing nothing wrong here, coming in to test the green line, or doesn't even get there. And again, up 1.71%. So we've got subsequent follow through again here. Okay, and you can see now this cluster here versus any of this is just completely different. But without the system, how would we know to get in? It would be the same thing here, same thing here. So at least we have something that we can use, 4th of Jan, day 7 follow through day to get in. And obviously from, the worst case scenario, so you bought at the close on the follow through day, just on an index level, you're up 4.23% right now. So again, clearly different scenario. Again, we just play this out, doing nothing wrong. And you can just see now this trend is just trending above the 21 day line, the green line. Coming up to the 200 day, gets rejected a little bit. And then it's just moving higher above the 10 day, really strong. Okay, so that's our first break below the 21 day, which is a sell signal. But you can see here, what a great trend. Let's have a look. From the follow through day, we were up, 13% on the close, below up 10%. So, like I said earlier, individual names can go up 1.5x to, well, I guess the same amount or up to three times more. Some high flying names, even maybe more than that. If you can get positioned, then, at least you have a chance to, partake in moves like this. So what I'm going to do is we're going to do a bar by bar replay just so I can keep the same date on. Now we've already done all this, so I'm just going to skip through. It's quite slow. Here we go. And then what we can do is we can look at some individual names just to show as an example what happened in that time. So let me write this down. So we had a day 7 follow through day on the 4th of Jan. We had subsequent the next day or the next trading day, which is the 7th. And then we had one on the 15th. And obviously we had more strength after that. But that's what we'll use for now. And we're going to play this out to the close below the 21 day on the NASDAQ or the Qs, whatever you want to use. Oh, okay. So then, okay, we'll leave it there. So the 7th of March, we break below the 21 day, which is obviously a sell signal. You probably won't sell all of it, but you would sell probably a lot of what you're holding, just obviously from a risk management point of view. So then what we can do is we can go out to, let's see if there's any in here actually, just any model books from that time. So we can, we can look at the likes of, let's just say Tesla. What was that doing at this time period? Nothing really. It was Square in 2018. Square, which is now XYZ. Trading view is pretty slow with so the market's open right now, and I've got the Zoom going, recording it, so apologies for it being slow. What's the next one? Is it video maybe? Oh. Netflix maybe? Sure, there was a big move in one of the names, one of the big names. Here we go. Okay, one example, 4th of Jan. So you can see, it's moving a lot more than the market. So yeah, there you go. So 4th of Jan, that was the first follow through day. Again, not a great chart to be completely honest, but the principles there, this was up 24, 25% until the first break. So you can see it's kind of a lot stronger than the index. Let's go to some liquid names. Apple. Geez, the market's taking a hit. It's not good. Okay, so maybe not that much setting up. I'll have to go through and look what was a big leader in 2018. But the idea is it's just a way of getting in and out of the market. Obviously, emotions are a huge part of the game, and when you come on a big decline like that, how do you kind of handle them? And you need rules to get you back in. You can't just be emotion because you'd never buy down here. You'd feel terrible, and you'd feel nervous that it wouldn't work again, just like these two times. So it can be tricky. That's why we use this kind of method, like I said. All right. So where were we? So again, March 7th, break below the 21 day. Then the next day is a gap down and it's bought up all day. It's an upside reversal in spirit, I guess, because it's not really got above the previous day, but that's positive. And then the Monday we gap up and go back above the 21 day line. So again, that's a follow through day, in itself within the terminology. Um, so you can again use this as a signal. Okay, we could be getting moving again here, and here you go. You've got 1, 2 days up in a row. That's a buy signal here because you're above the latest high, and you've got 3 days with the low above the 21 day again. So we'd be back in the market here. Tested the 21 day going up. Okay, and it's really strong. Let's see how far this goes. Can't actually remember. Yes, it's starting to break down here. You've got your green line rolling over. But look, this is a great trend that you'd want to take part in. Oh, that's Albi making that noise, sorry. Up, on an index level, up about 19-20%. That's pretty good. Let's switch over again now to what should we try? Try Google. What I want to do is pull up the records and see what model books we had in 2018 and 2019 to kind of show you. But yeah, it was a great trend. And again, the follow through days can be used for, as a rule to get us in and out, well, in and stay in. Give us odds of whether it's going to work or not specific odds like people know it, but information. If we get subsequent follow through days, then fantastic. It just more information that we're going to power higher. Let's have a look. Here we go by year. All right, let's have a look at another one. So we'll exit the replay and we will play through an interesting one, which is 2020. So again, to recap, follow through day is day 4 or later from a market low. We start counting on the first up day or a pink rally day, and then ideally we get a follow through days on day 4 through 10. You can get them after that, which is absolutely fine. They're the kind of most common, or give you most probability that they're going to work. And then what we look for is a gain of 1.25%. If it's a really low volatility environment, you can look at 1%. I think ideally we would use ATR, which is average true range, on like a 21-day look back period and kind of gauge it from that. But I guess the IB, Investors Business Daily folks haven't got round to kind of looking at that yet, and you'd have to do a huge back test which ultimately I don't really have time to do. But it would probably make more sense to do it using ATR than just general percentages because especially now the markets move a lot more, as an example, now than they did 50 years ago on a day-by-day basis. So we'll show this 2021. So obviously this was COVID. We'll do a replay here. We can just go from this one here. So we've got upside reversal here. So high closing range, it closes. So this is the open here and it closes near the high here. So that's day 1. We can start counting that because it's what we call a pink rally day. And then this is day 2, day 3, and that's day 4. So that's up 3.85%. So it is classed as a follow through day. Um, Now, what I would say is you got to think about the positioning again. We're below all the major moving averages. The 21, oh, sorry, actually, no, we're above the 200, but we're below the 21, which is our main focus. So you have to treat it, as a follow through day. However, just buy something and just see if it works out. You don't have to buy loads, just, get a kind of a toe hold in there and just try and use that position as feedback. So we'll go on to the next one. Okay, gap down, um, -3% on that day. So you'd be backing away from anything that you bought the day before, which is frustrating. That's our ultimate low there, 8,264. So again, we'll play this through. Okay, upside reversal off the 200 day, but you can see how volatile it is. I mean, this was such a great trend here in 2019, and then COVID news hit here. Gap down, huge down day again, and then it really becomes volatile and really tough to position in anything. This is when I really got focused on the markets here. Um, just a crazy time, obviously, with everything that went on. But, you were getting kind of halts during the day, which doesn't happen very often at all. That's where indexes go down. I think there's certain rules around it, but I think it's 5% on the day, and then they hold the market for 15 minutes just to let things settle. And obviously, there was the crash of um, Black Monday in 87, I believe it was, which was just relentless selling. So the idea is it's like a circuit breaker rule to prevent that from happening. But we were getting them in here, which if you're just getting into the markets and you're having these crazy moments, they last, in memory for sure. Wow, that's crazy to see that now. So that's down 7.29%. There would have for sure been a circuit breaker on that day. And closing right at the lows of the day. So it's gone all the way up and then closed all the way back down. So your expectation here is that we go lower. So let's see. Okay. Strong day because it did go lower just slightly and closed at the high of the day. So you can count this is day 1 now with that upside reversal. Okay. Undercuts to start the count again. Wow. It's a bad day, down 9.43%. Okay, so this now becomes your low here. So this would be day 1. We can start counting. Okay, scrap that. Okay, so that is now day 1 with again, it's up 6.23%. I mean, the volatility now in this bit compared to here, it is crazy. The ATR on this 4.6% on the 21-day ATR. So that means it can move up or down 4.6% on the day and be completely normal, which is a lot. So you'd only ever, I mean, stocks are going to be so much more. I mean, let's have a look at, I know Tesla moved a lot in this time, and it did hold up relatively well compared to the market. But you can see we just had a 9% down day. That was 18%. 18%. Crazy. So you can see the individual names will move a lot more than the index. And especially in periods like this, you have to be really careful with what obviously you have in the portfolio. If anything, you definitely would just be probing with tiny positions, nothing big at this point. So anyway, let's play this on. Okay, make a new low. Continue to make a new low. So this is really tough and frustrating, but ultimately it keeps you out of all this. When we break below the 21-day line, if you get defensive in here, you miss all this. So all these gains that you've got in here, you keep, and you don't want to give them back because look, we give back everything that we've made between, say, October and February in a month. So have to be super careful, and that's obviously a big focus of mine, is trying to, keep the gains and just tread lightly in these moments, because you can easily give everything back. So enough rambling on. That's Pink Day Rally Day. It closes down on the day 0.27%. However, it's in the upper 50% of the range. So that can be classed as day one. So that would be day two, three, day four. Day four follow through day, 26th of March. Great. Mark that. Okay. So again, like we said before, that low there, the follow through day low, is a line in the sand. That's the first line in the sand. The ultimate low is here. We wouldn't want to go below that, because we'd have to start counting again, but we wouldn't want to go below the follow through day low, because the chances of it working are very slim. So again, you have follow up here. And a big part of the follow through day process was volume. But I don't use volume anymore. So you have to take this with a pinch of salt. I know they didn't count these as follow through days because of the volume was so the volume has to be greater than the day before to count, and the volume was crazy in this time, but they didn't count these as follow through days because the volume didn't meet the requirement. So for what I'm doing in here, I'm not using volume, so I'm going to count these as follow through days. Again, we have the subsequent one here. And we fail at the 21-day line, and we break below. So you'd be backing out of any ads here or anything that you put on, watching the ultimate low. However, you got to be very careful in here. So this is day one, two, one, two, three, four, and we had a day four and day six. So we're on 7, 8. Okay. And then you get one up 7.33% here. And it's now above the green line, the 21-day line. So that's a completely different picture now to the other ones that we've had. And there was a slight one in here, but this is at 1.72%. But again, just the look doesn't look right, because it's basically an inside day on the day before, where the low is above the prior day's low, but the high is below the prior day's high. So it's kind of just wedged between that low. So, well, between that bar, sorry. So again, you have this one. This is going to be day 1, 2, no, sorry, 1, 2, 3, 4, 5, 6, 7, 11. Okay. And April 6th follow through day. So I remember this one very well. Failure straight away, but then kind of bounces back the next day. And now you have 1, 2, 3 days with the low above the 21-day, and the close is up. So this is a buy signal in itself. We want to be adding exposure, and then as you can see here, it makes good progress up to the 200-day, above the 200-day. Okay, break back down, and then now it's really pushing higher, and the trend's changed now. So getting using it, we got in here, as opposed to now you could say, oh well, it's getting up to the 200-day and it might fail, so I'm going to be cautious. But this is telling you that you need to put the foot on the gas. You get the follow through day, then you get above the 21-day, you get the low above the 21-day for 3 days in a row, closing up, which is a big thing, like I said. And ultimately, it lets you catch this trend. So we'll just play this out. Okay, so test to the 21-day line and upside reversal. So that, again, you could buy through on this day through the high of that day, or you can buy on this day in general with all your stops, to the low of the day. So here, that's the 14th of May. Let's take a look at what some other names are doing. So again, Tesla's just in a range. I know Amazon moved out pretty good in this time frame. Yeah. So as you can see, that's your follow through day there in the market. Okay. And Amazon's already up about 20%. So just shows the difference. Yeah, so that looks great because I mean, Amazon was already above the 21 day whilst the market was below, and then it pushes out. So, that would probably be a name that you'd be buying on the follow through day. Again, with a stop to probably the low of the day or close below the 21 day. And like I said, it was up 20% in a flash. Again, holding above the green line. So always looking for, after a big correction, a follow through day, and obviously what stocks are resisting going down. Because if they resist going down, they have a better chance of moving up after that. So just going to play this on now until we hit any issues. Okay, so it gets volatile in here, but again, you don't really close below. You don't. It's at the 21 day twice, but upside reversal again. So buy signal here, good power off the 21 day there. So a real strong trend. Another upside reversal off the 21 day. And then it's just slowing down here, but you're staying above it. Really powerful. And again, from the follow through down the NASDAQ now, we are up about almost 40%. So we can take a look at, I know Tesla made a big move in this time frame. So again, we've got the April 6th follow through day here. Okay, it's not really moving, not really pushing out. And then it had earnings here, gapped down on earnings. Well, sorry, gapped up and then faded on earnings, down the next day, and then started to put in a tight range, and was buyable. Everyone saw this ascending, kind of flag triangle look. And it just stepped up sideways, stepped up sideways. I mean, here this is great action because it's so tight to the 21 day, and it's just clearly showing support. So we can see from this kind of flag like pattern, you're up about 115% with the market up probably from those time frames, probably 20%. And again, like as an example, this buy here, up off the 21 day, you're risking 4.5% on the trade. So size that accordingly. And it makes a quick move up, about 80%. Not all, they don't all move like that, of course. And this is an exceptional time, but the idea is, you're screening for these names that are above the 21 day when the market is trending nicely. And you want to capture these moves as best you can. They're not all this strong. Obviously, you can get a lot of back and forth kind of whipsaw action in some trends. But you have to just use the rules that you have in place, to get you in and to get you out of the market. So we'll quickly do one more. I think this is interesting for most because it was the Brexit vote, I believe. It was 2016. Yeah, so in here. So we'll just go over this one again. Oh, we do this one first. So again, go down, rally up, go down again. You've got the ultimate, you've got a new low here. That's a rally day because it's 68% closing range. So that's again greater than 50%. We count that as day one. So you've got day 1, 2, 3, 4. That's up 2.21% above the 21 day line. So that's a follow through day. And again, it goes below this low intraday, but it doesn't close above it. So this works on day 4. Again, subsequent here, good power here, and then you get a nice trend. What do we get? About 10% on the index level. breaks down, makes a new low here, 60% closing range. So that could be day 1, 2, 3, again, fourth day, up 2% back above the 21-day line. So again, you would press the gas here and get defensive here. You'd get defensive here on this bad break of the 21-day line. Obviously here goes up, fails, closes at the low, and then we come down. Not too much, but you just wouldn't want to be involved in this. You wouldn't want to give back all these gains you made between Feb and April, so 2 months. Your account could be up 10, 15, 20%, hopefully more in this period. You don't want to give that back in here when you don't need to. But you can see it gets choppy in here. So I believe this was the Brexit vote. Let me just June 23rd. Yeah, so it was on June 23rd and it would have come out overnight, I believe. And you can see the next day the market did not like that at all. Well, the Nasdaq anyway. Break below the 21-day gap down, and it was down 4%. And then the next day down 2.41. So good washout there. It, you'd definitely be out of everything. You would be in cash here, though you wouldn't want to own anything in that environment. That's just a bad break, and it's not in its natural. The market doesn't look like it's respecting anything up and down below the moving averages, below the 21-day. You have 1 day up, and then it breaks below. So we'll just play through this. If it will move forward. So, well, sorry, 2 seconds. Okay, so like I said, you'd be in cash here, and then why is it so slow? Market's breaking down, by the way, bad. Donald Trump's come out with a tweet about China and tariffs. Okay, day 1 is here because we have a low, and we have a low, and then the next day we're up. So this is day 1, day 2, day 3, day 4. What's that? 0.41. But you can see we've recovered all of this. So it's kind of just a shakeout, a rip back up to highs, well, near highs. And then we have a test. What's this up? 0.75. So again, we don't qualify. 0.36, 1.64. So here we go. So we have 1, 2, 3, 4, 5, 6, 7, 8. Day 8 follow through day here. And we have this kind of double bottom look-ish where it gets above the midpoint here. And then let's see how it plays out. Okay, we're up again. And again, it's like I said earlier, with the getting the low above the 21-day, that can be a signal. When you get the 3 days above it, it's a buy signal in itself. But it's good when you get a combination of all these acting at once. Because it's, again, like I said, more information and evidence to push on the gas. So trending up here gives you a little pause, digestion. I imagine in some individual names they would have just gone sideways. So then you can get in and manage risk tightly, so you don't have big wide stop losses and risking a lot of your account. We like it when there's kind of a tight spread to obviously enter into a name, and when you're wrong, because a break below that you would be out. Let's see how this plays out. I can't remember how this plays out. Obviously wasn't trading at that time, but I've gone through and looked at it before. It's really strong. It's just literally above the 10-day the whole time. No real issue. Coming into the 21-day. Okay, bad break here. So you can see, again, worst case, you buy on the close of the follow through day. Until your bad break of the 21 day, we were up about 6%, 3% at the low on that day. But like I said, individual names are going to be up a lot more than that. So yeah, that's the follow through day, um, you know, process that we go with that I use. I think it works great. Obviously, is it perfect? No, of course not. But it gives us, tools. It's a tool that we can use to, get in and out of the market, and ultimately it's a signal to, get back in. So this is today's action now. So we're testing the 21-day line on some news, I believe, and you can see some individual names are down quite a good amount. So we'll see how this plays out, but we've not really made any progress on the index itself for about 2 weeks now. So it'll be interesting to see how this plays out. So yeah, thanks for watching that one. If you did, hopefully you enjoyed it. For me, this was just good to go over a few different time frames again, looking at follow through day principle, and need to keep an eye on that if we break down now, because we've been trending for a good while. If we break down, I'm going to be looking for, like I said, a marked low that we can then start counting after that. You want to follow through day 4 through 10. If, ideally it can be after that period. There's been something like day 23, 28 or whatever. But the most powerful ones typically come in that time frame. And then, like I said, when we make the low, if we go down on a day and close in the upper 50% of the range, we can class that as a rally day, and we'll count that as day 1. And then you cannot have a follow through day before day 4, and we need it to be up 1.25%. Typically, sometimes it can be less in a low volatility environment, like I said. So yeah, thanks for watching. I hope that was interesting and useful. And yeah, we'll see what the next few videos bring. Thank you very much.